Hello everyone, and thanks for tuning into the Financial Investor channel. And today's video, we're going to go over the power of dividends and why I became a dividend investor back in 2017. So if you are brand new to the channel, have not yet subscribed, hit that subscribe button below. I cover the stock market, dividends, real estate, and entrepreneurship. If you're interested in any of that, hit that subscribe button. If you do enjoy the video, hit that thumbs up. And if you have any comments, questions, go over anything in today's video, want to drop some information, drop it in the comment section. I always read and reply to all your guys' comments, and let's go ahead and get into the video. So back in 2017, I made a pretty big transition, moving from a growth investor where I had been over on Motif and then Robinhood. I had owned stocks such as Amazon, eBay, Tesla. I own Facebook, Weight Watchers, and a few others out there, primarily invested in growth stocks. I had owned Amazon since I believe 2013, 2014, and I had held it all the way until 2017 when I transitioned out of my Motive investing over to Robinhood. And then I was taking a look at the market, and it began to get to a point where I was feeling a little bit uncomfortable holding growth stocks. I had achieved so much when looking back at past performance during the 2000 tech bubble. They had lost more than 50% of their equity. Now, the S&P 500 is currently pulled up here on the screen, and here over the course, now I'm using SPY. This is one of the longest running ETFs, much longer than ticker symbol VU. I know a lot of you guys like to invest in VU. I actually invest in VU myself, but for this example, I'm using the SPY because this has been around since back in 1994 in its inception and shows a 24-year period of the stock market. Now, taking a look at the graph, we can see that it's very common for there to be secular bear markets every 8 to 10 years. So here we are in the longest running bull market currently. We recovered back in 2009. We're now in 2019. It's been 10 years. Here we had a stock market crash back in 2002, another one in 2008, well basically 2008, 2009. That right there was a 6-7 year difference right there. Right now, when I was looking at becoming a dividend investor, the stock market had already been at some all-time highs. We had already recovered everything from 2008's recession, plus we had doubled since then. Now, currently looking at the market back in 2017, I asked myself, am I comfortable holding growth companies that may fall, such as, let's go ahead and bring up Cisco and IBM. We'll just look up Cisco right now. But back in 2000, Cisco was a crazy stock, jumping at over $75 a share. Now, tech bubble took place. The recession drove its price down to, under $20 per share there. Now, it has trended sideways from 2002 all the way until 2015 before it began to get some traction, and that $30 point I started buying it back in 2017, and it is now worth $56.95. So this one has not yet recovered to that share price that it had prior to that tech bubble. Now another one here is IBM. IBM did go through the tech bubble. It did take quite a while for it to fully recover from that tech bubble, and then since this point in 2010, it shot to highs in 2014, 15 before falling and have not yet recovered. It may never recover due to its earnings and its growth potential kind of going forward. Now there are a few other companies out here such as Intuit, which has gone through that tech bubble. They didn't really, you can see here that there was a bit of a fall between 2000 and 2002, but for the most part, they just kind of continued trending sideways here at this low. If you had bought in these little spikes, that probably wouldn't have recovered for you for quite a while. It looks like maybe till 2011 or so. But as of this point, Intuit, which is not Turbo, I believe it's TurboTax, tax layer. Yeah, it's TurboTax. From this point, it has gone nowhere but up. And currently they're working with others such as H&R Block and a few other tax preparers to try and make it so that the IRS is not able to give out free software. They're making it so the IRS is not able to push free software for individuals to use for their tax services. Right now, if you make less than, I believe, 66,000 a year, you can actually go to the IRS website and have your taxes done free. But they're trying to make it into it, and a few others are trying to make it illegal or just not right for the IRS to do that. So they're going to try and make themselves a bit more profitable. Now, eBay did go through that tech bubble here back in 2000, but it, just similar to Amazon, has done a very nice recovery from this sort of tech bubble here. You can see that it did rise up and actually had a little bit of a recession or pullback here back in 2005, falling during the recession down all the way down to basically become nearly a penny stock, and then has recovered since then. Now we can see some recent earnings popping that stock from nearly $25, $28 point, probably a little bit, probably around $30 to about $36.39 now. We have Oracle here as well during that recession or the tech bubble that was up at $45 per share, fell all the way down to about $10, $14 in this range, and as at that point has steadily increased, but it wasn't until 2016, 2017 where this finally recovered to that stock price of where it had been prior to that tech bubble. Now, Facebook, Netflix, and Google here have not been around through the tech bubble. The oldest of these three is Netflix, which started back in 2002, looks like maybe 2003, 2004 period, and we can see here has trended sideways for quite a while. It wasn't until recently when Netflix started to become more profitable that this stock started to show some very good growth signs. Now, 2015, it must have had some really good earnings because this company went from being valued around $80, $90 here within this range to now over $359.46. Now, when you take a look at this graph and you take a look at Cisco or you take a look at eBay or IBM, are you comfortable with holding a company through a recession that has never actually made it through a recession? It hasn't had that 50, 60, 70% pullback. It hasn't had years where, now it's making really good profits, but into the future, when times get tough and not the sort of users of the program, are they going to be wanting to kind of keep their subscriptions around for Netflix, or are they going to look for other options, try and trim down their subscriptions? I know the FIRE movement's out there making use of kind of thinning down, becoming frugal on your subscriptions and items that you do not need. Facebook and Google here. Facebook, they've been really steady. They haven't had a whole lot of spikes until 2019 or maybe 2018 towards the end. It wasn't until that sort of what was it called? I can't think of the college or the whole scam, not the scam, but they had a big leak with a lot of their information, or the Russia information. I can't think of it right now, but as of that point, Facebook just fell hard here from a $220 point to now about $178. And this was not even considered a very big correction. I mean, it was a very big correction, but imagine Facebook going into a downturn where people aren't buying up their ads, they're not using the platform, and they're not producing as much income as they normally would during this growth period. Would Facebook maybe fall back 50, 60, 70% from these highs currently to be more valued at, say, $60 or maybe $120 from this point? Who knows? I mean, Facebook was down in that 140 range. I'm not sure where it would actually fall to if it did fall. But kind of going back here. Now, I became a dividend investor back in 2017, buying up companies. You've seen my portfolio out there, but one of them here is Cisco Systems. I have bought into this one. I have not bought into Intuit or eBay or Oracle or IBM, but what these 5 stocks here have in common is that they currently all pay out a dividend. Now, during times of pullback, yes, all companies normally will lose some sort of equity. Even some of the biggest names out there for dividend companies, Johnson & Johnson being one of those Goliaths, has gone down in price during those recessions. Here, if we take a look at the recession over the 10-year period, We'll have to look at the graph here. For the most part, we can see the tech bubble. This one did get driven down, but it did recover here within just a few years. And then during the 2008 recession, this one also fell pretty hard. But by 2012, 2013, it looks like it had recovered. So between 2009, 2008 until 2013, that's about a 4-year period, this company and many others out there were in the negative territory. Now, this company, for example, they pay out a dividend. This one pays out now 90 cents per share, but back in, 2008, this one paid roughly 40 cents per share, a little over 40 cents per share. So during this whole downturn, yes, you would not have got any sort of capital appreciation, but you would have got paid out 40 cents per share every single quarter that you held that stock. And if you continue to buy into that stock, buying back more shares, getting paid out more dividends, using those dividends to buy back more shares, and just continue that process over that 4-year period, by the time you actually reach this, being back positive in your portfolio, the company has recovered through that recession, you would have actually probably have achieved a 3% annual return during the same time frame, actually keeping yourself out of being into the negative there. Whereas companies that do not pay out a dividend, let's use Amazon for example, there would be no sort of dividend or payout to the shareholder. You would not have been able to buy back more shares. You basically just would have had to add brand new equity into the market in order to buy back those shares. So that's just sort of a quick summary of the S&P 500, the history and such. I probably want to create some sort of a better visual video kind of going forward, but for the main part, I was a big growth investor back in the past. I've doubled my equity since investing back in, I started investing in 2004, but this is just mainly through my thrift savings plan. It wasn't until 2008, 2009 that I started creating my own portfolio outside and began investing in a taxable account over at Vanguard. And then I transitioned in 2015 to Motive Investing when they started offering free. And then I moved over to Robinhood in 2017 where they had free, and they also started to offer some other bonuses that Motive was starting to get expensive to kind of use. And in 2017, I transitioned from a growth investor to a dividend investor, being focused more not on equity gains at this current time, because equity gains after a bear market, it's very easy. You invest in companies, they're going to rise. But during the end of a stick here, we have a stick, it's lit, and it's currently kind of coming back towards our hand. Eventually, it's going to get too hot for us to hold, and we're going to have to drop it. We're going to have to drop out of the market, or the market's going to itself just kind of drop. And as long as you're comfortable holding those growth companies when they're making no equity, they're not making any sort of return over a 1-year, 2-year, 3-year period, and you may lose 20, 30, 40% in your equity just within a few weeks or months very quickly, which had taken place back in 2018, where Facebook, Apple, Amazon, and many of these other companies lost over 20% of their equity just within a couple weeks period there. It's just things to consider. So this is just a very quick video kind of going over the history of the S&P 500, taking a look at 4 of the biggest growth companies, along with some of the companies back in the tech bubble that just never recovered, and just kind of giving you a sort of heads up going into the future. As long as you're comfortable holding those tech companies, if that works for you and you continue to hold and buy through the recession, you'll probably end up pretty well in the future. But can you stomach and take that gut punch there from these companies losing so much equity there within a short amount of time? So that is basically all I wanted to cover in today's video. So if you did enjoy the video, hit that thumbs up button below. If you do enjoy the sort of history, taking a look at the growth stocks and dividend stocks, let me know in the comment section below. And of course, if you are brand new to the channel, have not yet subscribed, hit that subscribe button below. And that is it. I will see you guys next time. Have a great day. Bye.